Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Sebastian, welcome back to the show, mate. Great to have you on.
Thanks for the opportunity. Appreciate it.
I thought maybe we could just jump right into it. When I saw that you guys were launching a private opportunities fund, I thought this is really, really interesting. For those who follow you and have heard the podcast that you and I did together in the past, they will know that you've always had this, predilection for small companies, long-term investing, high conviction.
Yeah.
And so I feel like in the current climate, this is almost like a natural extension of that. And so maybe for people that haven't gone back and listened to that episode recently, maybe you can just explain the NAOS business, and then we'll dive into the fund.
Yeah, sure. So, I think I spoke to you, must have been a few years ago. So it feels like an eternity ago. But lots changed, obviously. So, NAOS, in essence, what we try to provide is a very unique exposure to small companies in the stock market. But I think where we're quite different relative to our peers is our definition of small is probably a lot smaller than others. So we own some companies that are only valued at 20 million, while others, some might be valued at 200 million. So for many, that's really micro cap, but we call them emerging businesses. We run a very concentrated structure. So in our 3 LICs, which are NAC, NCC, and NSC, there's only about 10 holdings in each. So we're big believers in quality over quantity, which I'm sure you've heard before, but we probably take it to the next level where we're happy to be. And really only focus on what we believe are industrial type businesses. So the thesis or the philosophy revolves around five key points, being we really look for founder-led or heavily aligned businesses with management, where management are heavily aligned. So a lot of skin in the game is the term I'm sure you get all the time. They operate in industries that are conducive of growth. Happily will tell you that I've made a myriad of mistakes, and your mistakes are nowhere near as bad whether poor businesses but in good industries, I suppose. So I think it's for us, it's very important that the industry is conducive of long-term growth. Business has got a proven moat, it's got a competitive advantage. We've got a very stringent ESG screen. We've got quite a large ethical following now. So I think everyone throws a word around ESG, but for us, it's probably more about positive impact. So either in your community or environment or in both. And then the last one is, I've almost lost it now, is really about free cash flow generation or being relatively capital light. As I'm sure you would know, in today's environment, there's lots of businesses chewing up an awful lot of cash. But you haven't seen a whole lot come back to you. So we're really looking for businesses that can generate a lot of free cash flow, relative to their size, I suppose. And that's NAOS. So we started with, raised the measly amount of $17,313,000 in February 2013. We remember it like it was yesterday. And then, thankfully, we only had 400 investors, and today we run $400 million across the 3 LICs, across 8,000 investors, and really just focus on delivering the outcome that our shareholders expect. Like it's a very simple expectation process, reason why we're here, and that's what we're focusing on. And then obviously we're launching a new strategy next month.
So let's talk more about that. I guess I'm just going to start with the easiest, like the softball is like, why private companies?
Yeah. Why are you mad enough to go and investing in private companies? Yeah. Look, mate, I tend to talk it down a bit, so you might have to try and talk me up. But I think it's a hard one. I think for any fund manager, especially as they get larger, I think it's very easy to remain. We're not large by any stretch of the imagination, but to remain doing what you're doing. I mean, what we do can scale. Listed equities are easier because there's a market. Information's more readily available. It's easy to invest in listed stocks. I think it's always been a dream or ambition, especially for me, Rob and Richard, who've been here together for quite a while, and now more recently Brendan, that That's all well and good, but when I started NAOS 15 years ago, I've raised money 3 times in the manager, and I know you run your own business. Like, it's not easy to look for capital from the right sources when you need it, but that doesn't mean you've got a bad business. It just means it's a hugely fragmented market. It's not like you can go to the bank and say, I need a $3 million loan, and they say, well, that's $5 million. Can you mortgage your house? It's like, well, no. So then all of a sudden your ability to raise capital is pretty meaningless. So we really felt that with our network of, essentially a lot of our listed investments, I had a call with someone today, you almost treat them like private businesses because we do own 20-30% of some businesses. So it seems like a natural extension. But I think the thing that gets us so excited is there's been so much attrition in small caps, emerging companies over the past few years through M&A and all sorts of things, that we think the opportunity set in small caps is getting hard. It's getting more competitive. There are less quality companies, and therefore people are probably investing in things and taking more risk than what they should be. So therefore, for us, there's plenty of examples, but the private company opportunities for us seems very logical. To either go global or go private. I think global's done very well by plenty of other fund managers, but in our view, private investing is not done well by anyone, especially if you exclude venture capital and private equity. There's no real boutique fund manager that you can get exposure through to private companies.
So just to reflect on that for a second. So saying that small caps are becoming more competitive, is that just a function of there being fewer good small caps, or is it also a function of there being more competition in the market from analysts and research houses and that sort of thing?
Look, I think some people might say I'm biased because I suppose of our investment philosophy. So we're not the ones that are going to invest in the next Zip or Afterpay or whatever it may be. It's just not really our style. So some people might say, well, you're not looking in the right places. That's maybe a fair argument. But I would definitely say, I think when you look at the type of businesses that are no longer on the ASX, and you think of some places where you want exposure. So think of healthcare with revenue. So revenue generating healthcare companies, revenue generating manufacturing companies, even things like basic things like aged care. Like, it's almost impossible to get a good exposure to those thematics. Like, you'd be trying very hard. And for me as an investor, it's like, where do I want to be? And that's exactly where I want to be. Like, people think of like home care as one of the next big booms over the next sort of decade or two, at least. We can't get any exposure. Very hard to get exposure on the stock market. So for us, we think a lot of the good quality industrials have been removed from the ASX by people who can afford to take them private, and therefore we're left with probably more speculative businesses. And inherently, I think the thing that people miss is, if you're a business, why do you list? Generally, you list because you want to sell out as a founder, or you want to reduce your holding and I suppose crystallize that gain, or you require a lot of capital. And that generally means that you require capital to pay down debt, or your business is not making money, or free cash. And therefore, for us, there are 2 reasons why you wouldn't want to invest in a business. So very rarely do you see a business list for the reasons that excite you and say, geez, I really want to own this business in an IPO.
You actually included some stats in the slide decks, which I thought were really interesting to kind of speak to these points. And one of them was the fall in IPOs. So obviously you're excluding mining and energy with these numbers, which is good, because I would do the same. So from 2017, where you had 90 IPOs, it's now fallen to 31 in the first half of 2021. And then if we look at the opportunity set in public versus private companies, I think that's a really interesting dichotomy there too. Can you just walk us through kind of like how many companies are in this target market, like in your universe, as private companies, and contrast that to listed?
Yeah, so I think when we look at, I'll start with listed because that's really the easiest one because there aren't too many. But as you said, and as I in the point I made before, there are less and less, I suppose, businesses that we would invest in that are listing. So therefore, the amount of new companies coming to the market is less. You've then got attrition through M&A. So therefore, the net effect is you have less and less quality businesses that remain on the stock market. Keeping in mind that you've got to remember, like, if you think of, I'll give you some great examples. So 2 outstanding small caps that were small a long time ago. Dulux Paints was small a long time ago, gone, taken over, very high quality business. And the other one, which we've never owned, amazingly, is, I don't know if you ever followed ARB Corp. So they make the bull bars. I mean, I was looking at a report this morning. I think it's $55. Like, I remember starting when it was $5, and they literally just make four-wheel drive accessories. Yeah, but one of the highest quality small caps, but no longer a small cap; it's a large cap. So a lot of the good ones fall out of small caps because they become too big. So from our point of view, it only leaves us, when we look at, I suppose, you get rid of energy, companies that aren't making revenue, mining, which we don't include, that only leaves us with about 375 investments, between $5 million and $100 million in revenue. And then when you go even smaller, there's only about 67. So for us, that might seem large for a lot of people. Then the point I try to convey is, if you think of how many billions of dollars that are looking for a home in equity markets, the opportunity set relative to the amount of capital looking for a home is pretty tough, and that means valuations go up, obviously, as we've seen in stock markets all around the world and in the melter. If you overlay that with private markets, and I think, the thing that you should say straight away is that, let's face it, there are very few statistics on private companies because the opportunity set is just so big. But we think, we use the ATO data, but if you found businesses between $2 and $10 million in revenue, of which they're actually businesses, so they're not like a trust or something like that, there's almost 50,000. So straight away, you've got a huge opportunity set. But let's face it, there's going to be a myriad that aren't investment grade for whatever reason. But even so, we've been starting, before we launched the fund, we've already been having meetings for the last 3 or 4 months with private investments, and we've probably honed in on 2 that we want to invest in when the fund launches in October. And it's just a different conversation, a different type of business. There's plenty of businesses out there that do unique things to solve a problem that you and I would probably need solved. They've been bootstrapped by management and family and friends. We've found one that's been done like that for 15 years. And now they've found a way they can get external capital, and they're the conversations we're having, and they're the type of businesses that we're looking to find.
So how do you go from the ATO data to kind of filtering them? Do you just kind of, where do you get the numbers, or I know you use your network quite a bit?
Yeah.
And like a lot of them wouldn't probably necessarily be in the market for capital, I imagine, or
no.
Like, how do you get that conversation?
Yeah, look, to be honest, and this is probably the $1 million question. The biggest risk to our fund, without a doubt, is idea generation. And as you said, there's so many companies out there. Like, how would you even know where to start? And I think the sources that we've used, we've sort of given this a lot of thought. There's 4 things, because there's no silver bullet. So the first one is obviously our own network. So we own 30-35% of some businesses. A lot of those listed businesses do M&A themselves. So they've got a very good understanding of their respective industries, and some very good private businesses, but may not necessarily fit their business strategy as a listed business. So we'll start there. We've also used an investment advisory board. So we've got four people that we know reasonably well from a very eclectic, I suppose, background. So one, FMCG space as an example, who used to do a lot of distribution for some well-known brands such as Remedy Kombucha. The other one is big in the tourism space, someone in building materials, and then another one is actually runs a very successful financial services firm. So that gives us another layer into industries and networks that we wouldn't have exposure to. And then the other 2 really are inbound. So people approaching us. And I think for us, my ambition personally is, I wrote about this yesterday, is if we can make this successful over 5 or 10 years, and some people have done this well, you really want to be the partner of choice. Like when I'm looking to raise capital, I just don't necessarily want it from XYZ. I want it from someone who I know that I can trust, who can help me grow, who can be a mentor, who's not necessarily going to ride me every 5 minutes for the next exit. So I think if we can build inbound deal flow that way, and then the final way is advisors. There are no shortage of advisors out there looking to place deals. But I would say we've just genuinely been very surprised by the amount of opportunities that have come within 4 months, especially when you compare it to the listed market. I mean, it's been extraordinary. I think we've had almost 100 meetings in 4 months. And
of those 100, you've honed it in on 2 that could be, but that's a pretty good kind of strike rate for private companies. How about in terms of like valuations and that type of thing? How are you finding that those indicative conversations would be going relative to the listed environment?
Yeah, interesting, because one of the people on our advisory board is very successfully made the comment, is like, in regards to valuation, you'd almost close your eyes and forget about it, especially in today's market. So I think the way we think about it is twofold. Firstly, I think the way you can structure your investment, when people invest in listed businesses, they invest in, I'm going to go and buy a share and be an ordinary shareholder. When you invest in a private business, you have a lot more options. Like, you don't have to be an ordinary equity holder. You can either give them debt, you can put your equity in via a preference share or a convertible note. So it gives you a few more levers and say, well, I'm happy to be an equity holder at some stage, but if X or Y or Z occurs or doesn't occur, then I want my money back, or I want an interest rate. So it protects us very much on the downside, but at the same time trying to get the upside. So I think that's the most important thing we do, is how we structure the initial investment. And then in regards to the second one around valuations, you're coming off a much lower base. Like, they generally tend to be smaller businesses. So their potential to grow is a lot more significant than probably a larger business, just from law of numbers. So yes, the headline valuation may look not that dissimilar to a public business, maybe slightly more attractive. But I think the valuation relative to the growth potential would be exponentially much better. And that's what we're finding. So yeah, the multiple's it's not like I'm paying, I don't know, I'm trying to think of an example. 20 times, 25 times EBIT for a listed software business, and I'm getting one in private markets for 10 times. It might be 25 to 15 times. But the 15 times has the potential to grow significantly because it's a smaller business, hasn't had, I suppose, the years to grow into that multiple.
What are you finding in terms of when you do your due diligence? How is that, I guess, different relative to the listed structures?
Yeah. Look, the hardest thing about being a fund manager is people just will lie to you at some stage, or a lot. So I think it's your job to try and weed out the truth from what is not the truth. And I think in listed markets we've definitely improved on that, and I think a lot of that can be applied to unlisted investing or private investing. So the two schools of thought are, firstly, the information that we can get access to is significantly better. I mean, I think if you're an investor in a listed company, you can't go up to someone and say, in some cases you can, but say, I want your accounts, but I want your key supplier agreements, your employment agreements, your constitutions, your shareholders agreements, your business strategy paper, all these sort of things, all your input costs, output, statistics. They're just not going to give you that detail, especially that granularity. But as a private company, they can do that because obviously they're not bound by the same rules as what an ASX company is. So from day dot, your information that you get is just outstanding. I think the issue is whether or not that information is real or not. I think there'll always be an element of, well, trust me, and it's up to us to try and work it out if that's real. And the way we do that is the same we do in our listed companies. So it's about, sure, you talk to the source, so the owners and operators of these businesses, but you really want to talk to, it's like if someone wanted to invest in my management company, they'll go, all right, I'm going to go and talk to Seb's peers, his competitors. I'm going to go and talk to Seb's former employees, current employees, people that have invested with him, people that have invested but pulled out their money, and get a real holistic view of what NAOS is, what they stand for, and whether or not what he's telling you is real or not. And that's exactly what we do, and we do it across numerous sources. And it's never going to be perfect, obviously, otherwise we'd be doing much better than we are today. But it'll give us, on average, with law of numbers, if we can get more, we can get more right than more wrong, and the ones that can go right go up exponentially more than the ones that don't. And we should be doing very well over the longer term.
How about then in terms of like realizing gains, right? So I imagine some of these companies might pay dividends over time, fully franked. Some might be, well, most of them would be fully franked, I imagine. But how about that in terms of exits? Because obviously one of the things that we think about is like liquidity in private companies and having a vehicle for that. I know that the fund is going to be like a 5-year term, right? Is that right? Yeah. How about in terms of like realizing gains? How do you expect to realize them over time? Are they going to be IPOs, buyouts?
Yeah, that's a good question. So I think many people that have sort of ventured into pre-IPO investing, it's called pre-IPO investing because they expect an IPO. I think we've deliberately not called this fund that, because these will be private businesses, and inherently a private business, the hardest part is getting an exit. So I think the way we think about it is, I think the first one is how you make your investment. So if you invest in not just ordinary equity, if it's debt or a convertible note, where you can sort of, not artificially, but you can sort of secure your exit at some stage. So if I've given you a three-year convertible note, then at the end of 3 years, I've either got to give you money back or you convert it into equity. But I think more importantly, a lot of these companies are looking for expansion capital, and as part of expansion capital, they're looking for an exit at some stage as well. But I'm a big believer that it will predominantly probably not be IPO. Some will be, but I think there's a lot of businesses, bigger businesses out there that are doing M&A. They need to acquire to grow or increase their capability or service offering. We've even found that a lot of businesses, especially founder-led, they're just looking for growth capital, and then they might do a management buyout in a few years' time. It just gives them the capital they need to take to the next level. And then after that, they're looking to take back 100% ownership. And that happens a lot more than people think. It's not like a once in a blue moon scenario. So I don't think it's like we're just praying that, someone's going to take us over or we're going to do an IPO. There are a lot more levers to pull where you can be refinanced out or someone else can take over your shareholding, especially if the business becomes much bigger and better than your initial investment.
I've always thought to myself, if I was a fund manager, I'd love to move into private company investing, because I think it's just a truer form of investing, because like you said, you do have access to that information, which allows you to see what's actually happening, what's really happening, if you can get like proper numbers. As you said, not all of it's true. So where do you expect over the next few years the better opportunities to come from? Like, would they be kind of, technology companies, like smaller technology companies, or healthcare, construction?
Yeah.
Any sort of feel for it so far?
Yeah, that's a good question. Putting me on
Obviously,
the spot.
things are going to change in time, right?
Yeah, I think this is going to sound like a bit of a very broad comment. I think definitely what we're seeing today is everything that we're seeing is innovating in some way. But just because they're innovating doesn't mean they have to be a technology company. Like, we've seen some fantastic businesses that are innovating, but they're in the infrastructure space. People go to you, how can I innovate in the infrastructure space? It sounds like it's been done to death. But because there's so much money going into that space and it's probably been set in its ways for so long, there are just so many ways that you can innovate and change processes, even just how you maintain a toll road, and where that information is held, and the scheduling and things like that. So for us, I think we're probably going to be, as I said, we're focusing on certain areas. So I think big ones: healthcare, aged care. We don't do anything around consumer finance and stuff like that. We'll steer clear. Infrastructure is another big one. For us, we like tourism, especially domestic tourism. Except again, that's very hard to get a good exposure to. It's almost impossible. But I wouldn't say there's a specific area where we think more ideas are going to come from. But I definitely feel like more people, especially entrepreneurs who are starting their own businesses, will start them in more traditional spaces, but with an innovation slant. And I think you would see that from all the businesses that you see, people you talk to. There's a lot more younger people, even older people, that are setting up in traditional areas such as tourism or whatever it may be, with an innovation slant, doing something differently, and they got significant potential. It's like we saw I was telling someone the other day, like a luxury walking business that didn't exist 15 years ago. It's just walking around Australia, like in certain
walking.
Yeah,
how does that work?
Yeah, so it's like they get a lease off a council or a state government, and say, like, we know one that's been bought, like in Maria Island, and so you want to go for a luxury bushwalk with your family and luxury tents or whatever it is for a few nights. But we know there's some out there that would make more than $10 million of pre-tax earnings. And people go, really, like a walking business? But if you think about it, coming out of COVID, it's like, well, no, I couldn't afford it. But like, if I wanted to take my family on a luxury bushwalk in the Kimberleys or something, you can see why people want to do it. And I think the way, things like that, I think there's some fantastic opportunities out there. You just got to find them, unfortunately, and you've got to find a willing party. That's the other trick as well.
How about in terms of like shareholder agreements, and how do you do? I think you've got in-house like legal. Yep. So is that how you do a lot of that kind of legal due diligence on shareholder
Yeah.
agreements, trusts
Yeah,
and all that
yeah,
sort of
it
weird.
gets a bit legal and wordy. So I'm lucky enough. So thankfully we've got Richard here, who's been there with me for 6 years. So he was at Deloitte. He was our auditor actually. So he joined here 6 years ago. So obviously got excellent knowledge in regards to financials, audits, management accounts, things like that, systems, processes, controls. And then Rajiv, who actually joined us from Magellan. He was their legal counsel team for a while. And he joined us a couple of years ago. And, it really gives us a lot of ability as opposed to just seeking external counsel. As we know with our own agreements that, when you're investing in a business, you think you're going to be treated like everyone else. But unfortunately, you only know you're going to be treated like everyone else when you go through a shareholders agreement and constitution. And we've probably learned the hard way a few times, but unfortunately, they're probably the most important documents that you're going to read outside of, even probably more important, the financials is the shareholders agreement. So what happens if, a great example is if, say a company gets a bid and, 60% say they want the bid to occur and 40% don't, and maybe they need a higher hurdle. Well, is there a tag and drag? So does that mean the other 40% have to go along with the other 60 and things like that? Because unfortunately, not everyone thinks the same, depending on the circumstances, and that can lead to some pretty awkward situations, and hence why shareholders agreements there to protect everyone, especially in a business, and hopefully we can do a lot of that DD in-house with Raj.
Another interesting thing that I saw when I was reading through some of the docs is since we last spoke, could be saying, there's been a lot of emphasis put on ESG, and they've got in-house capabilities in this regard too. How do you see, I guess maybe I'd love to catch up with you in a year after launching the fund, is like how would you conduct that due diligence from an ESG perspective in private companies? Is it the same process or even an easier process because you do have a better understanding of them?
Yeah, look, I think it's important to say that, and not many people would say this, because I think there's a lot of fund managers coming out saying we're ESG aware or we have an ESG product. And thankfully, there's more articles coming out now that a lot of fund managers are probably greenwashing and things like that. When we started this a few years ago, we said we were very much ESG aware, but by any circumstances, we were not where we needed to be. And because we have such large holdings in our listed companies, as you touched on before, that gives us great access to management and executives and even some of the tiers below. So we've decided that in regards to our listed businesses, and this will follow on to private businesses, is we give our listed businesses now a yearly questionnaire. And it's not questionnaires on, I'm not big on stuff that people can't relate to, like, I don't know, is X, Y, Z in your corporate governance statement? That's all fine. But it's really stuff that I want to be able to relate to. It's like, how do you support your employees? Talk about your maternity leave programs. How do you support employees that might have, a couple of kids or something like that? Stuff that's quite granular. How do you support your community? Even, school, or not school sports, but community sports programs. It's quite stuff for us that, we can relate to, but we also think is quite meaningful. And then that also then revolves back into the environment and carbon neutral and things like that. So for us, not every business is perfect, but what we want to see is an improvement. We've invested in some businesses that were nowhere near perfect, and probably some would argue we should invest it in. But 5 years on, they've come a long way. And that's what we're expecting from our private businesses. They may not be where they need to be, but I think it's important that as long as they have the same values or similar values to us, and they're looking to make the same improvements and ambitions in regards to these principles, then that's fine. And then as long as we can measure those and agree on what the measurables are and where we want them to go, and that's all we ask for. I don't think you're never going to find a business that's the perfect business in that regard. But as long as everyone's making an effort and moving the right way and providing the right measurables, and that's all we ask for.
So another thing I didn't know on that topic was that NAOS has got the 1% pledge.
Yep.
So yeah, did you want to explain that?
Yeah. So I think over the journey we've done a few things. So obviously we've signed up to the UN PRI more recently. We've put our B Corp application in. So fingers crossed we can get that. It's taken a lot of effort. We've brought on an ESG analyst as well, and then we've done the 1% pledge. So we actually started this a few years ago, which my CFO didn't like because we've never paid a dividend for the management company. But effectively, the 1% pledge revolves around. So 1% of our recurring revenues goes to 4 charities now. So I think we've given, I don't know what it is, but it might be close to $300,000 or $400,000 now. I think one's to Bush Heritage, the Royal Flying Doctor Service in South Australia and Northern Territory, Kookaburra Kids, which is kids who are affected, their parents have severe mental illness, and the other one is Greening Australia. Yeah, and so that just allows us to give back into regards to those charities. And then also it's about 1% of, and we're trying to implement this into 1% of time and 1% of intellect. So allowing staff members to pick a charity and then go and support them in a physical manner, hands-on manner, as opposed to just financially, I suppose.
Mm-hmm. Yeah, I think it's it reminds me of how Salesforce does it in the US. They have a 1% pledge as well, which is kind of time capital, all that stuff. Yeah, which is great. Okay, so there's just a couple more questions I have about the fund specifically, which are, how do you think about portfolio construction in this regard? Because I think you're targeting between, is it $20 and $35 million to raise, and you've got two. You said you've got maybe there's 2 options that have kind of bubbled to the surface so far. How are you thinking about portfolio allocation, over time, but then also deploying that capital? How long do you reckon that will take?
Look, I think it's a hard one because it's in an ideal world you wouldn't have the 5-year term. I think I'd be upfront to say that, because it probably places pressure on you to invest sooner rather than later, because you don't want to make your first investment year 3 and then you've got to exit in year 5. So I think there's definitely a little bit of pressure to invest sooner rather than later. Hence why we started before the fund actually launched. It will be a concentrated fund. $35 million is not a lot of money in private investments, but I think we're very much here to prove the model as opposed to raise as much money as we possibly can and just hope that we can prove the model, because that wouldn't be great for the brand or for anyone else. So I think if we can get $35 million, which we're confident we can, and then deploy that across 6 to 8 investments, we're thinking $5 million per investment. So based on the feedback, that is sort of what people are after based on what they require, how many other people will invest. So we may not be the only investor, we don't expect to. So we may find an investment and we've got other people that could co-invest with us. So if the business is looking for 15, we might put in 5 and we can find the co-investors for the 10, which works well. But because it is so concentrated, it'll be diversified by industry. So we're very cognizant of not having half the funds in healthcare or half the funds in building materials or whatever it may be. So I think there'll be 6 to 8 very unique investments, of which maybe 2 will be in the same industry. That's how we think about it. And I think the other part is, they're all real investments. So they've got to have revenue of at least $5 million. So it shows you that, I suppose it's a bit like this business, but, we're through $5 million. So it's taken us a bloody hell of a long time. But it shows you that you have developed a competitive advantage, hopefully, and there is a moat. And I think most importantly, especially for Brendan, because he was a CFO of a listed business until a few months ago. It's shows you that the business has got resilience. It's proven that it's competitive moat, and it will have the ability to develop over time, hopefully, as opposed to investing in something that's more of an idea. We leave that to the experts, of which there's plenty.
Mm-hmm. Mm-hmm. So it's $100,000 minimum investment into the fund and sophisticated wholesale only, right?
Yes, that's right. Yeah. Not retail, unfortunately.
Yeah, that's right. And it's probably appropriate given the term and the structure of the
business. Look, I think we definitely have thoughts about doing a listed investment company because all of our other ones are fixed. But I think for where we are today and how far we are, not how far we need to go to prove the model, I think it's the right type of investor for this fund.
Yeah, and can you just explain basically the fee structure and all that stuff?
Yeah, so all the exciting stuff. It's pretty simple actually. So raising $35 million, it'll be in a closed-end unit trust where you'll get monthly NAV statements, so NAV updates, charge a 1.65% management fee, which is payable monthly. and then a 20% performance fee over a fixed hurdle. And the hurdle, from memory, really put me on the spot because it's changed.
I think it's 5.5.
Yeah, so it's 5.5, but the management fee then goes on top, so it gets closer to 8. That
7.
makes sense. Sorry,
Oh,
7.
Yeah.
7. So yes, because it's post management fees. So yeah, fees are a hard one, but relative to what we've seen out there, we think it's fair. And I think the other bit is these funds there is a lot of legwork involved in regards to investing and information, DD and things. So hopefully the returns offset the fees.
Yeah.
More than offset the fees.
Yeah, for sure. And I think that's worthwhile to point out too, right? Is that the performance fees payable when the performance is there, right? So
and we haven't been cheeky. There's a high water mark. The benchmark compounds, like it's everything you'd expect from a proper benchmark and profit performance fee.
Yeah, because and that's like in terms of like private equity partners and those types of things, it gets pretty murky with a lot of those guys, right? So
internal rate of returns and per investment and all sorts of stuff.
Yeah, so that's good. It's a really interesting business, mate. And I struggle to think of any if not business but fund. I struggle to think of any that have tried to do it in such a way, combining kind of that higher conviction, longer term focus. Like a lot of the funds will have, as you say, pre-IPO in like in an allocation of like 10% or something, but few have, but they need kind of immediate exits because they're liquid and all that sort of stuff. Whereas this is something more long-term focused, which is really, really interesting.
Yeah, I think my view is, especially as a boutique manager, you do something, do it well, and it's got to be different. And like I said, as running my own business, I just think there's a big need for something like this. There's a huge opportunity. Whether or not we can execute is to be determined. But we've got a good track record of doing it in the listed space. We're under no illusions that the private market's going to be harder. But we think there's a huge market and there's the ability to scale. But most importantly, I think the other thing that's interesting is a lot of it resonates with our investor base. Like generally, most of our investors are self-managed super funds, and a lot of them have run their own business, so they can sort of resonate with it and say, look, if I want X% of my portfolio in this space, I do want it in small businesses that require private capital, but I can't get it. I don't know where to go.
Yeah. Okay. So if people want to find out more, we'll send them to the show notes, and there'll be a link to register their interest. And I think that the form there allows them to check if they're a current NAOS investor as well. So you can get on the list to find out when the fund goes live. It looks like through October is going to be pretty busy for you in terms of webinars and kind of explore this more with investors.
Yeah, we're doing 2 webinars. I think the first one's on next Wednesday, and then the other one's halfway through the month. So the funds applications open from the 4th, and then they end at the very end of October, and the fund launches on the 1st of November. Because obviously we call all the capital up front. We did an expressions of interest out to our shareholder base. The feedback was a lot better than we thought, so we're very confident. But as you said, I'll be pretty busy trying to get what we're doing across, because it's not as simple as the other 3.
For sure. Well, Sebastian, thanks for taking some time to chat with me on the show. Really appreciate it.
Yeah, no, thanks, Owen. Take it easy, and I'll talk to you soon.
Cheers.
Thanks again.